Today I will be analyzing Prevas AB. Here are the contents. Prevas in Brief. Discounted cash flow analysis. Graham's valuation. Net profit margin analysis. Revenue distribution analysis. Ratio analysis. Acquisition analysis. Analyst expectations. Major shareholders. And then final comments. So first I want to take a look at Prevas in Brief. Prevas is an innovative development house with a focus on product and production development, where ingenuity is at the center. We use great technical expertise and business understanding to help our customers within widely different industries to gain greater benefits from the technological advances of our time. Good for people, the planet, and profits. And now I'll go on to discounted cash flow analysis. So on this left side, we can see how I calculate the discount rate. I do this by using capital asset pricing model. If you take a look at here, the risk-free rate is basically the 10-year US Treasury yield bond. And then the expected market return I've set to 8, which is neither low nor high. It is, I would say, perfect. And then the stock's beta, which I've searched up and found. So our discount rate for Prevas comes to 9%, about 9%. And then here, there's the shares outstanding in millions, which is 12.89. And then free cash flow, fiscal year 2024, in SEK billion is 0.12. And then we have the intermediate term growth rate for the next 5 years. There are two of these, as you can see here. One is personal, and then one is according to analysts. In the personal, I put 5% annual growth. And then according to analysts, they also expect around 5%. And then this is the average of those two, as you can see. And then for long-term growth rate, I set it to 1.225 to be conservative. If we look at the intrinsic value here, it comes out to 2.33 billion SEK. And then the intrinsic value per share comes out to 181 SEK. The current share price is at 69.7 SEK. So this would mean that the share is undervalued by 61.52%. So if we assume that there is absolutely 0% growth here for both of them, and then if we also assume there's 0% long-term growth rate, even then the share is undervalued. Intrinsic value per share comes out to 153.9 SEK, when the current share price is only 69.7. Even this would mean a 54.7% undervaluation. If we move on to Graham's valuation, I use a different method. This time I am conducting a reverse Graham's valuation. So what I did here was I plugged in the EPS 12-month trailing and then the AAA corporate bond yield. And then what I did was I set the current price per share in SEK at 69.7. And then the projected growth yield, I'm going to tweak it a little bit to see when it exactly matches the intrinsic when it exactly matches the current price per share. That seems pretty close. This means that Prevas has to achieve a projected growth rate of 22.5% to match up the share price. And now I'm going to go ahead to the net profit margin analysis. On top, I have set years from 2020 to 2024 with revenue and net income, from which I've calculated the net profit margin listed here. And I've also made a table, a graph to represent this data. This shows us that from 2020 to 2022, the net profit margin has been increasing. But then from 2022 to 2024, it has been on a decline. This may also be a reason why the share price has been dropping, as you can see here. Take a look at this. The share price from its peak at 2023 has dropped more than 50% to where it is now. Okay. If we go ahead to revenue distribution analysis. So here on the left side, I have set the countries, Sweden, Denmark, Finland, and so on. And then here is the revenue in million SEK. And then I've set this as a percentage of the total revenue. And on the side, I've listed some of the major customers. For example, in Sweden, we have ICA, who's a major supermarket, and Cloetta, who's a snacks producer. And in Denmark, we have Arla and Carlsberg. And in Norway, we have Orkla. And then in Great Britain, we have AstraZeneca, pharmaceutical company. And I also made a pie chart to represent this, to represent where most of the revenue comes from in terms of country, which we can see is more than 75% from Sweden. And then if we look here, I listed industries, for example, energy, automotive, and transport, and so much more. And then the revenues in million SEK. And then I also calculated the percentage of total revenue here. And I also plotted this on this graph where you can see here. So Prevas generates most of its revenue from engineering companies, which we can see here is 22% of its revenue. And then if I go ahead to ratio analysis, on the left side we have the ratios. We have the price to earning, price to book, price to sales, price to earnings to growth, and debt to equity ratio. Here are the current values they're sitting at. Here are the industry averages. And then here and then here are the company averages. And then I've left some comments here. So the price to earnings is currently sitting at about 10, and then the industry average is about 30, and then the company average is about right, is like almost the same here. If we compare it with the industry average, this seems to be an undervaluation signal. If we look at the price to book ratio, it's currently sitting at 1.29, and then the industry average is sitting at 5, where the company average is sitting at 2.14. This means that the price to book ratio seems to be undervalued in both situations, from the industry average perspective and the company average perspective. Now, if I look at price to sales, the current ratio is 0.57, where the industry average is 8.6 and the company average is 7.9. So same as before, both the industry average and the company average seem to be much higher than the value it is sitting at right now. This is also an undervaluation. The price to earnings to growth, I think we're going to skip for this one because the data seems to be a bit wrong. So we're just going to disregard this for this analysis. And then we move on to debt to equity ratio. The current debt to equity ratio is sitting at 0.43, where the industry average is 0.48 and the company average is 0.24. I always like to buy companies that have a debt to equity ratio under 1. This meets my criteria, but if we look at this from the company averages perspective, it seems that the company in recent years has taken on more debt. I will come back to the reason in a bit. The company also has 17.23 million SEK in its cash reserves, down from 48.9 million SEK last quarter due to repayment of debt, which is a good thing. And then I'll move on to acquisition analysis. Here on the left we got company name and then when they bought or when they sold. And then here we have the date. I tried to look for the price that Prevas bought them or sold them for, but I couldn't really find data. In total, Prevas paid 270 million SEK for all these companies. They acquired this money from issuing some new shares, which I put here, where you can see. They also used some cash reserves to buy these companies. And then we go on to analyst expectations. Uh, so like the 12-month price target in SEK is set to 132.5, and the current share price, this is a bit wrong, 67 point, my bad, do we go back, 69.7, oh, 69.7, yes, which is an implied upside of about 90%. And then the analyst also expects earnings growth of 22% and revenue growth of 5.3%. And then we go on to major shareholders. Here we can see all the names of the shareholders and then their ownership percentage as long with their voting rights as well. And then I have some comments here. I have highlighted some of the shareholders' names, as you can see. The London family, I'm pretty sure they are a family. They own 26.5% of the company and 28.66% of voting rights. And if we look on the right side, we can see the distribution between institutional investors, individual investors, general public, and private equity firms, which I also made a pie chart for, which you can take a look at. All in all, I think Prevas AB is a good investment, and I personally also own shares in this company.